The model of Bitcoin is based on the highest degree of decentralization and massive distribution of miners who have contributed computational power to the integrity and stability of the blockchain. It is termed security data centers for miners, who form the core of Bitcoin's security system. Through a process called proof of work, they verify transactions and secure the network by solving complex mathematical puzzles. Newly minted Bitcoin and a share of the transaction fees that accompany every new block mined are also their rewards. Block reward is considered one of the driving incentives for miners. It was designed as a means to bootstrap the network during the early stages of its inception. The Bitcoin network has a limited transaction capacity. It can process around 30,000 transactions per hour, which means there is a race in which every user tries to get his transaction included in the next block. To incentivize miners to prioritize one's transaction, therefore users have to bid transaction fees. If a user wants a transaction to be processed quickly, then he/she will pay a greater fee so that he can compete with all other transactions. This gives rise to a market for transaction fees as high-rolling stakeholders. Those who make large transfers or need to get paid quickly will pay more for guarantees of being in the next block. As the demand for Bitcoin transactions ramps up and more people take to using the network, the cost of doing business there rises, which could drive fees into stratospheric levels in the future. To understand this better, think of high-stakes financial environments, such as real estate transactions. The costs involved in transferring a large amount of money from what might be deemed a small New York City real estate deal to $10 million in cash may involve transaction fees of millions of dollars. Similarly, Bitcoin transactions would also be subject to significant expenses for high-level operations. It would be a pattern particularly from the standpoint of demand for space in the blockchain, when the pattern is widespread adoption of Bitcoin. This is similar to conventional industries. How the economic structure of the system, a free market such as Bitcoin, functions similarly to real estate commissions or transaction fees in financial markets, whereby limited space or bandwidth pushes up the price for confirmation of transactions. One of the more striking features of Bitcoin mining, and also often overlooked, is its dependence on low-cost or excess electricity. Mining Bitcoin is very power-intensive. Miners require lots of electricity to run the complex calculations needed to secure the network. But Bitcoin mining operations tend to cluster in areas where energy costs are low or even negative. For instance, there are places such as solar power or wind power that are rich in renewable energy sources. Their customers normally consume less power than the amount of power generated. These places exploit the surplus electricity by making miners operate at almost no cost. This ease of mining Bitcoin with almost free or even stupid prices for energy is what makes it economically viable in the long run, even when its price will fluctuate or it will be going through market downturns. With essentially free energy, the operating costs of mining are dramatically reduced to near zero, and miners can continue securing the network, even in a bear market or in low market prices. However, those with expensive electricity sources could turn off their operations should the price of Bitcoin or transaction fees not accrue enough revenue to sustain it. Bitcoin mining is also inherently an investment in the long term. Miners need to make a significant investment in capital to purchase the mining equipment that usually costs millions of dollars, and these have very short useful lives. The particular machines used for Bitcoin mining, which are truly quite efficient, have only a finite working life. These are known as ASICs, or Application-Specific Integrated Circuits. Once accumulated, these miners cannot be used again. Therefore, they become a sunk cost for the miners. However, Rewards are motivated to continue operating even when declining, as they have no other means of recovering their investments, but through continuous mining operations. This creates a one-way economic incentive. Once the capital has been invested, the only thing one can do is keep mining for Bitcoin with no regard to prevailing market conditions. Another factor that will ensure long-term sustainability of Bitcoin mining is a steady decline in costs of mining equipment with the passage of time. Similar to other high-tech industries, mining equipment prices are likely to come down considerably in the long run as manufacturers refine their processes and technologies. This presents a phenomenon analogous to Moore's Law, which explains the decrease in the cost of semiconductors with their improving power. In this case, no matter what happens to the price of Bitcoin, even if it were to fall, the steadily lower cost of mining ensures that miners who can work at low-cost energies are survivable. A secondary market for second-hand mining equipment will always exist over the network, in which the old hardware of miners is offloaded to individuals who have access to cheap power. Such technological innovation that leads to Bitcoin mining also makes this network safe. ASIC miners are designed especially for solving the puzzles of Bitcoin cryptography or securing the network. When these machines are designed and manufactured, they can only perform that particular task. They are so secure and very resource efficient, but make it hard for new miners to come into the market. The cost of securing the network, therefore, is both the more efficient running of the hardware and the more Bitcoin stays secure, the more it can afford the slowing issuance schedule and decreasing rewards. Conclusion. Through this design, Bitcoin's network has been able to have incentives to long-term investment in mining hardware. That is, the security of the system will not depreciate. An economic model of Bitcoin mining, having a structure based on block rewards, transaction fees, and cheap electricity, will result in a strong, self-sustaining system that confirms decentralization and secures the Bitcoin network. Transaction fees will increase in response to demand from a growing number of transactions in need of block space, even as the block reward dwindles. Also, the efficiency of mining equipment will continue improving. This marriage of economic incentives along with technological innovation creates Bitcoin mining as a strong and sustainable model for securing the network, which would continue doing so in the many years ahead. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.